There are a number of different ways to record the price of inventory sold, which is also referred to as the cost of goods sold. There's the last in, first out method. This means that we use the cost of the most recently purchased inventory in calculating cost of goods sold. This method is favoured by some due to its scope for earnings management, for instance overstating the cost of inventory sold to understate profits, thereby decreasing tax liabilities. This method is not conformed to Australian accounting standards but is used in other markets, notably the USA and Japan. The moving average calculates the average cost of all inventory on hand available for sale and multiplies this by the total of inventory sold. This provides for a smoother picture of costs and profits over time by ironing out fluctuations in inventory costs. Specific item identification keeps a track of the cost of each individual item of inventory. This is useful for businesses dealing with low volume, high value inventory such as jewellery or fine wine. And finally, the first in, first out method. This means that in calculating the cost of goods sold, we record the price we paid for the oldest item of inventory. This is an easy method to calculate, is difficult to manipulate, and usually corresponds to how inventory is physically moved within a business's operations. Let's take a closer look at recording transactions using the first in, first out method. Journalising the purchase of inventory and the sale of inventory using first in, first out method. First, we will add our entries for the purchase of 100 units of inventory at $1 each. We'll debit inventory 100 and credit cash 100. And then we'll have a second further purchase the next day of a further 100 units of inventory, this time at $1.10 each. So we're debiting inventory $110 and crediting cash $110. Now we make a sale of $100, which is actually 50 units of inventory we're selling for $2 per unit. And now in calculating our cost of goods sold, we move back to our first purchase of inventory and we take 50 of those units we purchased at $1 each and we debit cost of goods sold for 50 and credit inventory for 100 to record the cost of goods sold. Now we make a further sale of $200 or 100 units of inventory, debiting cash $200, crediting sales revenue $200, and calculating our cost of goods sold, we take our first 50 units from this $1 per unit and the second 50 unit from $1.10 per unit for a total of $105 as our cost of goods sold. A useful tool for keeping track of the price you paid for inventory so you can record it correctly is a simple spreadsheet, quite similar to a journal, organised chronologically, has a list of our purchases and our sales, and on the right we calculate subtotals of our inventory on hand and its value. That way we can keep a track of the value of the inventory that we're currently selling, and it has a closing entry for the final value